First trend of the day, time Technoplast is the stock which is in focus. The stock has surged almost 130% over the last 1 year. What's led to the surge and what are the prospects for the company going ahead? Joining us now is Mr. Anil Jain, who's the MD and CEO of Time Technoplast. Mr. Jain, good morning to you and thanks a lot for joining us today on Bloomberg Quint.
Good morning, and I wish your viewers and your team and you a very happy new year.
Thank you, Mr. Jain, and wishing you a very, very happy 2018 to you as well. But let me start off this interview with the input cost pressure which the industry has been talking about, and considering especially for you when the crude oil prices have been inching higher, has it impacted your input cost in the third quarter?
Navneet, quite frankly, the crude prices and the polymer prices have divorced themselves a long time ago. If you look at the new generation polymers that are being brought in the market, they actually come from the gas route. And if you look at the prices of gas, they have been rather constant. There's an abundance of supply of gas in the Middle East, in Iran, and lots of other places. I think the prices of polymer are mostly driven by demand and supply situation. Currently, yes, the prices are a little bit up because China have been buying a lot, but I think it is now tapering down and the prices will be back to the normal one. I expect for the next 2 or 3 years' time that the prices of polymers will remain constant or probably will be having a negative bias. So we are not too much bothered about the prices of polymers. Yes, of course, the market is picking up, the demand is actually picking up. In fact, if you look at in India, we had a rather quiet Q1 and Q2, but the Q3 things have started picking up. And we are pretty hopeful that in Q4, at the end of this year, we should be achieving our guidance.
So Jain, so firstly, if you could reiterate your guidance for us, and secondly, from what I understand is about nearly 70% of your revenues comes from abroad. So if you could also take us through the key geographies that your revenues come from, what are the product lines that are being sold there that is driving growth out there, and if there are any other geographies that you intend to expand into over the course of the next 1 year.
Okay, yes, you're right. Actually, we have operations in India and also overseas. We are now present in 10 countries. Something like 71% of our revenue, of course, come from the Indian operations, and 29% actually comes from overseas. In overseas, we are present in Taiwan, Malaysia, Indonesia, Vietnam, Thailand. And if you go to the other side from India, we actually are in UAE, Bahrain, and Egypt. And only about 3 weeks ago, we bought our competitor in Saudi Arabia as well. So we are pretty happy. In fact, the growth overseas is about 20% per annum. In fact, we maintained the same growth last year as well. So the percentage of our overseas contribution will actually be somewhere around 30 or 32% because the domestic business is also picking up. The margins more or less are the same overseas and in India, but there is a lot of headroom available for us to grow. In fact, in the current financial year itself, we have expanded our product portfolio in our overseas operations, and we now have the IBCs being manufactured in all the countries together. Encouraged by the response that we received from overseas, in fact, I'm very pleased to tell you that in all the countries that we have gone to, barring Malaysia, we already have become market leaders in just 6 years' presence. Now we expand our footprints. We go to Philippines and to Russia by middle of next year. And then after that, we probably will be going to Africa. So we have identified Nigeria and Kenya to be the places. So we plan to add 2 countries every year from here onwards, yes.
Mr. Jain, could you talk to us a little bit on your composite cylinder side of the business? I think there were some expansion plans going on there. What's the current status and what's the capacity utilization from this space?
Well, as you know, before we came in for an expansion, our total capacity for composite cylinders was something like 700,000 cylinders. And keeping in view the order book that we had, we decided to expand our capacity. In fact, we doubled it from 700,000 to 1.4 million cylinders. This capacity already has been installed and commissioned. Of course, as you know, that there is an approval process for a new facility which is currently on. I think we should be through with this in next 8 weeks' time, so that capacity can also be pressed in service. But insofar as our existing capacity is concerned, we are close to about 65 to 70% of the capacity utilization. But we have the order book, which should actually be able to engage our additional capacity as it comes on stream. Yeah.
Mr. Jain, just a counter question there. You said you've doubled your capacity from 700,000 cylinders to almost 1.4 million. Is the current order book taking care of the added capacity or just the previous capacity of 700,000?
No, I think we have the order book in currently at about 1.8 million cylinders. But of course, it is scheduled. We were waiting for the new capacity to come in because we were not actually been accepting all new orders. But now that the capacity is on stream and the certification is going on, we should be actually booking more orders. But you're right, actually, the order book that we had of 1.8 million cylinders, that was essentially keeping in mind our existing capacity of 700,000 cylinders, and that should really be able to consume in next 2 years' time.
Okay, Mr. Jain, so you mentioned that you are looking at 2 new geographies every year. In that case, I wanted to understand if, what sort of investment this is going to entail and how you intend to deploy it based on the markets that you are entering into, and how you intend to fund these investments then.
I mean, we have a very robust cash flow available to us. So we are going to be engaging that. Our expansions do not really engage a very large resources. So it will be mostly done by internal accruals. We have a plan. On an average, we'll be investing something like 200 crores per year going up to 2021. And we are trying to keep our debts at the same level as they exist today. So most of it is going to be out of the internal accruals. Since these it will take about 18 months from the start when they start contributing, so we don't really see that will be a drag on our resources. But we are pretty excited because those are the countries where technology-based products are not available right now, and we should assume the market leadership in those geographies as well, like we have done in the geographies that we already have gone in the last 5 or 6 years.
You said you're looking to maintain the current debt levels, which is somewhere about 700 or 720 crores. Is that a correct number?
Yes, the debts are something like 750 crores. So we should really be able to maintain at the same level. But internally, we have set out a target. In fact, if you look at our guidance for up to 2021, we have very clearly said that we will be, in terms of turnover, be around something like 5,000 crores or above that. We will be having the EBITDA of about 700 crores at that point in time. Our debts, we have very clearly stated that it should not be more than 2 times of the then EBITDA. So that's the discipline that we are going to be following. Of course, we are much less right now. It's about 1.5, 1.6 times of our EBITDA. But we are quite comfortable. Should the expansion requirements come up and we require more capex to be done, we have the capacity and resources available to be able to do that.
So you're suggesting that the focus of the company is currently on expanding its capacity and to maintain the debt levels, because if I look at your numbers, you are making cash profit, which means you can definitely lower the debt levels, but the focus is now on capacity expansion.
Well, I mean, we can reduce the debt, but the question is whether we would like to reduce the debts, which are already quite under control. In fact, if you look at the debt to EBITDA at about 1.1, 1.5, 1.6, that shows that the company probably is lazy and they do not have the opportunities to grow. I think we'll keep a balance. We don't go overboard. So that's the reason why I said our debts at any point in time will not be more than 2 times of the EBITDA. And since those resources are going to be available, we will be constantly looking for capacity expansions, both in India and overseas. Of course, the overseas we are into industrial packaging, but in India we are bringing in quite a new products. As you know, that we launched a product called MOX films, and that has taken up pretty well. We started with a capacity of 6,000 tons. We sold out the capacity within months of starting that. So we have doubled the capacity. In fact, We had expected that to come on stream by end of this financial year, but we have advanced it by at least 2 months so that we are able to catch the new season. So we are doing that. We are also doing some surface protection films, and next year we will be launching our CNG cylinders, which is for the carbon fiber, and it has a huge potential. So since we have the business opportunities available to us both in India and abroad, as I said, we would not be too much concerned about the debt levels so long as we maintain the discipline that they don't exceed 2 times of other than EBITDA.
Okay, Mr. Jain, from the reports I've been reading, what we understand is that there's more and more awareness now to replace materials like wood and paper and metal to a certain extent by polymers in the business in which you are in. What I wanted to try and understand from your company point of view, what are those product or product lines that could drive that are leading right now, that are driving growth for the company?
Well, if you look at our entire business, there are 3 things which are common. That is polymer technology and innovation. So we are fully focused. And if you see, we can define our business as one where we are replacing metals with polymers in high performance areas. And I can give an example. Industrial packaging is one. We are making fuel tanks, which are replacement of metal to plastic. We are doing composite cylinders, which is replacement for the metal cylinders. So that is, we will be doing CNG cylinders, again a replacement of steel cylinders. Insofar as our future growth is going to be, we have opportunities available from our existing businesses. So we are expanding. So wherever the growth is possible, as the GDP grows, we will be growing ahead of that one. But we are bringing in what you call as a value-add products, where we see the EBITDA margins to be something like 18% or thereabout. So we are expanding those areas. We see in value-add business, our growth will be about 64%. Yeah.
Mr. Jain, quickly, just a last word on your key expectations from the union budget this time around.
Well, I think we already have to thank government for the GST. In fact, that has been a God's gift to us, considering that we have 20 locations in the country, and our logistics is a very important part of our business. So that's great. I guess we keep our expectations low because we don't expect very many concessions to come. Government has got priorities, and there's one full budget before the election. I guess we are happy if they just keep improving the ease of doing business. Not many expectations now, really.